Hi everybody, we're back again. We're going to do the next portion of this practice problem. And it says here to refer to the information from the original practice problem on Phoenix Company's actual income statement. And here's the actual income statement for 2015 as follows. Everything we had been doing up to this point, by the way, has been budget. So a flexible budget or a fixed budget. And now they've given the actual numbers to their income statement, and it's saying prepare a flexible budget performance report for 2015. Well, this one is for 18,000 units. So what we're going to do is we're going to go back to our flexible budget that we prepared in the last problem. And we're going to look at the one for 15,000 units. We did have one that we had to solve for, but check it out. Here's the 18,000 units right here. We only did like a cut down version of it. So we had $101 contribution margin per unit. We had fixed costs of $1,356,000. Okay, so we kind of got that far, but we had to get more detail. So we're going to go back to these numbers here because we have to get the variable cost per unit to come up with a flexible budget. So it's going to look like this. Our flexible budget at 18,000 units. These numbers, sales and all the variable costs, of course, they were all derived by taking each of these dollar per unit amounts and multiplying by 18,000 units. So as a result, 18,000 units times $200 per unit will give you $3.6 million in sales. And of course, every direct material, direct labor, machinery, all these down here, all these variable expenses, they're taking, these numbers here are derived by taking the dollar per unit times the 18,000 units to plow all this down, and we have a contribution margin of $1,818,000, which, by the way, was the same contribution margin we came up with earlier when we did this what ifs problem. Here's our total contribution margin at 18,000 units, 1,818,000. So we have the same contribution margin, so we know we're on track. Our total fixed cost, 1,356,000, will come out to be this as well, 1,356,000. And of course, the numbers that make up all of our fixed costs will come right from our schedule from earlier, okay? So 1,818,000 minus fixed cost of 1,356,000 will give us total operations of 462 and 462. So everything looks like it's in agreement. We calculated everything correctly, and now we will take these numbers, and this is based off of actuals. So 3,648,000, 3,648,000, and then everything else that goes on down the line. We're going to go ahead and list them all out. Depreciation, that's a fixed amount. Depreciation is a fixed amount because it is a straight line. So that's going to show up down here, okay, at 300,000. Utilities, it says fixed is 147.5. Well, then the balance of that 200,500 is going to wind up being variable, and that's going to show up right here at 53,000. And then the 147.5, the fixed portion of it, is going to be down here in utilities. And then everything else, plant management, salaries, 210, packaging, 87.5 is variable, shipping, variable, sales salaries, fixed, advertising expense, fixed, salaries, fixed, entertainment, fixed. So now we have our budget, our flexible budget at 18,000 units for actual sales at 18,000 units. So you're comparing apples to apples at 18,000 units. And we can now do the difference between these two and put the difference over here, and we decide whether it's favorable or unfavorable. Now the difference meaning that if it says that we earned more than we were budgeted to earn as far as sales are concerned, then that's considered a favorable variation. Okay, so good job, pat on the back. However, we look at the costs, and if it turns out that our cost for direct material was higher than our budget that was supposed to be used for that, and it's over by 15,000, that's considered an unfavorable variance. Because why? We spent more than we're supposed to. Same thing over here. For direct labor, we spent more for labor than we were supposed to be, because we're budgeted only 270 and we blew it. We went $8,000 over budget. And so you go all the way down and do favorable, unfavorable for everything, including fixed costs. Now fixed cost was 0 for this one, so yippee-ki-yay, there's no effect. And then overall income came out to be 9,000 favorable, because we took in more money than we were budgeted to take in. And that actually concludes this last portion. I will not go talk about question number 2. That's superfluous. Thank you.